Hello and welcome. My name's Bridget Thalander, and today I'm joined by two members of the WAM Leaders team, Anna Milne and Hailey Kim. Thanks for joining us. Anna, we'll start with you. As a residential developer, will Mirvac benefit from the RBA rate cuts?
In short, yes, Mirvac will benefit from rate cuts as it improves housing affordability. It's not often we have a stock that fits our investment process perfectly, but Mirvac is in that space at the moment. It fits our macroeconomic view with these rate cuts coming through, which should benefit Mirvac. It has really strong fundamental tailwinds as margins in residential have bottomed and should be improving from here. And from a sentiment perspective, it has a really large office portfolio as well, and the office market really has turned. So it really fits the macro, fundamental and positioning for the WAM Leaders process.
Fantastic. And Hailey, we talked about this in the last Talking Stocks episode. Can you please give us an update on Amcor?
Yeah, a lot has happened to Amcor since we last spoke on it. So late last year, they announced that they're merging with Mirvac Global. They're both flexibles and rigid packaging companies of similar size. So strategically, it's a good deal in our view because it really adds to Amcor's subscale rigid business, and it also broadens their flexibles product offerings. And they also paid a reasonable multiple for it too, only 10% premium to various valuation, which compares to Amcor's last deal of this scale, which was BMS, where they paid 25% premium. The company's also put out a big synergy target of $600 million over 3 years, and a large part of that comes from procurement. And the execution of this is really key to Amcor's investment thesis for us, and we are quite comfortable with it because Amcor has a track record of delivering on synergies and taking cost out as part of their normal operations, also very much in Amcor's DNA as well. And operationally, they're both doing really well. Volumes have returned to growth, and also they're protected from the volatility related to tariff because of their largely regional business models. And input costs are also mostly passed through. So it's a solid defensive exposures at an attractive valuation for us.
Fantastic. And Anna, after a difficult couple of years, APA's share price has bounced back recently. What's changed?
APA's result was strong, but focus was on the balance sheet. There has been concern that APA would need to do a capital raise to fund its dividend as well as its growth pipeline, and management came out quite strongly saying not only can they fund the dividend, they can fund their $1.8 billion development pipeline and have money left over for future growth opportunities. The market really underappreciates the free cash flows of this business, and with the regulatory overhang gone and its assets only becoming more strategic, we think APA is still good here.
Hailey, the ACCC released the final report on the supermarkets recently. Tell us, what does this mean for Coles and Woolies?
Yeah, so the ACCC released their final report on the supermarket inquiry last Friday. It included 20 recommendations around competition, consumer experience and suppliers. It was very lengthy, 400 pages in length, but I guess in short, it looked quite balanced to us, and I guess the direct impact for the supermarkets from the financial perspective could be quite minimal. And it now gives the supermarkets a bit of a clearer air to really focus on the operations. To touch on those, Coles has been executing quite well. They've got a great trading momentum, which is very important in retail. And Woolies, there's still a lot of work to be done, including on the supermarkets and Big W and New Zealand business. But I guess given the de-rating it has seen, we can see a case for a re-rate as it goes through the strategy review and the cost out. So while we do recognise that there are still, tough operating environments for both supermarkets in the near term because volume growth is subdued, food inflation is coming off, and they're still navigating through the inflation across all their cost of doing business lines, we can see an opportunity for both supermarkets to outperform because they're great defensive domestic businesses, shielded from concerns around slowing global growth.
Anna, are the worries of weight loss drugs weighing, excuse the pun, on ResMed?
ResMed's share price has been weighed by these weight loss drugs, and that's really because vast majority of ResMed obstructive sleep apnea patients are obese. If these weight loss drugs are effective, the obese global population will reduce, and so will ResMed's total addressable market. ResMed has come out and said quite sternly that they think this is only an opportunity for them. It increases their funnel, it improves awareness of treatment for OSA, and they're really now embarking on a brand refresh strategy, direct to consumer advertising, given the rise of wearable devices such as my own, that can tell you if you have breathing difficulties in your sleep. The proof will be in the pudding, and the jury to a degree is still out, but their last few results, they have been executing well. It's valued still very cheaply, and they're delivering 10% earnings growth tied not to the economic cycle, tied to their own fate over the coming years. So we like ResMed at these levels.
Fantastic. And Hailey, the BlueScope Steel share price has pulled back recently. What's your view on the stock?
Yes, it has given back a lot of the gains that it got from the result day in February, and we think it could be a buying opportunity. I guess when you think about BlueScope, still the largest drivers of the share price are the steel spreads in the US and Asia. So I guess to touch on those, the proposed steel tariff in the US could provide some support to the North American steel spreads in the near term. And Asian spreads have been quite resilient as well. So we think the current steel spread assumptions affected in the guidance could be conservative. And then from the operation perspective, the company is really committed to driving growth and also the cost efficiencies of over $200 million. And balance sheet is also in a great shape with net cash. And we also like the fact that companies put out a new framework in assessing how they deliver returns on capital investments going forward. And then there's value to be unlocked from their property book, including West Depot near term. And lastly, valuations screen reasonable to us, especially considering the end market being close to bottom of cycle.
Beautiful. And Anna, Telstra, it's been a favourite of the WAM Leaders team. What's driving the share price higher from here?
It's a good question, Bridget, because we have spoken about it at length for a couple of years and we've held it in the portfolio at varying weights. Our initial thesis was one on price increases. We gain more value from our mobiles than ever, and therefore we expected Telstra could really push the price envelope quite a lot harder than they were doing. This has been the case. The next part of the thesis, which is what's unfolding currently, is its dividend yield. Previously, they've been spending a lot on CapEx, free cash flows have been slightly more muted, but now with the price increases coming through and capital expenditure needs declining, they are entering their free cash flow era. And this really means the dividend should continue to grow over the coming years. So if you assume that the dividend yield is growing, Telstra's share price should too.
Fantastic. And last but certainly not least, WiseTech has been through some turmoil. Hailey, what's your view on the stock?
Yeah, that's a really tough question because there are still some uncertainties and therefore risks from a timing perspective. But I guess taking a step back, when you think about the fundamentals of this company, it's one of the most profitable and innovative company on the ASX with great products and a great founder leader. They are a leader in what they do, which is global logistics software. And they have been expanding their addressable market through innovation, which will really underpin the future earnings growth. The founder has now returned to the business and will really drive the product innovation and also the growth strategy. And I guess we think it's a positive if it means that they'll get back on track, including product launches that were delayed, and he'll really drive the business forward. And the company is really committed to appointing an independent board member and remain compliant with the ASX listing rules. So I guess on a risk-reward perspective, it screens positively to us.
Fantastic. Well, thank you, Anna and Hailey. Thanks for joining us and thanks for watching. If you'd like to hear more investment insights, please subscribe to our emails. Thank you.